It was a Friday afternoon in early spring, and a woman in her early 60s was sitting at her kitchen table in a quiet subdivision outside Columbus, going through a shoebox of paperwork that used to belong to her father. He died the previous September. She'd handled the funeral, the house, the car title, the credit cards. She thought she was done. What she didn't know, what nobody at the bank, the funeral home, or the attorney's office had told her in plain language, was that a clock had started the moment her father passed, and that clock had nothing to do with grief or probate or even the will. It had to do with a retirement account worth $340,000 that she had just inherited, and a federal deadline buried inside the tax code that most families never hear about until it's already too late to fix. By the time she found out what she'd missed, the number the IRS was prepared to tax her on had already changed. In the next 20-some minutes, I'm going to walk you through exactly what happened to her, why it happens to thousands of families every single year, and the 4 specific triggers inside inherited IRA law that turn an inheritance into a tax bill. The last one is the exposure most families already have sitting in their accounts right now, without knowing it. Before I go further, subscribe to this channel and turn on notifications because I cover federal rules, IRS rules, Social Security rules, Medicare rules that agencies are not in the business of explaining to you upfront. Nobody at the IRS calls you to say you're about to make an expensive mistake. Nobody at the custodian bank flags your file and says you have 9 months to fix this. That's not how these systems work, and that's exactly why I make these videos. Here's the pattern I see over and over, in case after case, and I want you to sit with this for a second, because it's not what people expect. It is almost never fraud. It is almost never carelessness in the way people imagine. Carelessness, nobody's ignoring their mail or throwing away statements. What actually costs families money, real money, 5 and 6 figures at a time, is a missing form, a missed deadline, a box that should have been checked and wasn't. And here's the part that makes it so dangerous. None of it comes with a warning. There's no letter that says you're approaching a critical election deadline. There's no red flag on the account. The system simply processes what's submitted, and if nothing is submitted or if the wrong thing is submitted, the default outcome, which is almost always the most expensive outcome, just happens quietly in the background. And you find out a year later when your accountant asks why your taxable income tripled. That's the legal foundation you need to understand before anything else. Under the Internal Revenue Code, specifically the provisions governing required minimum distributions found in Section 401 and 19, and the distribution rules that were substantially rewritten by the Secure Act of 2019 and further modified by Secure 2.0 in 2022, inherited retirement accounts are not treated like a lump sum. You simply absorb into your life. They come with rules about timing, about who you are relative to the deceased, and about elections you have to affirmatively make. In writing on time with the custodian or the account defaults into whatever treatment costs you the most. The IRS does not calculate the best outcome for you. The custodian does not calculate the best outcome for you. Both of them process exactly what is submitted on the timeline the regulations require, and nothing more. The Treasury Department's own estimates, along with data compiled by the Employee Benefit Research Institute, put the amount of unnecessary tax paid annually on mishandled inherited retirement accounts in the billions of dollars. Nationwide, not because families are trying to avoid tax, but because they never learned the rules exist until the deadline that would have protected them has already closed. So let's get into it. 4 specific traps. I'm going to give you the rule, the citation, a real case that shows you exactly what it costs, and the form or action that fixes it. Because knowing the rule without knowing the fix is just trivia, and I don't do trivia on this channel. The first trap is what I call the 10-year clock, and it is, by a wide margin, the one that catches the most families off guard, because it's brand new, relative to how people think about inherited IRAs. For decades, if you inherited a retirement account from a parent, you had a lifetime to stretch out the distributions, take a little bit each year based on your own life expectancy, and let the rest keep growing, tax deferred for decades. That's gone. Under the Secure Act, for most non spouse beneficiaries, adult children being the most common category, the entire inherited account must be fully distributed within 10 years of the original owner's death, not stretched over your lifetime. 10 years, full stop, under the framework in Section 401A9.H of the Internal Revenue Code. And here's where it gets more complicated, because the IRS issued proposed regulations in 2022 and then finalized guidance in 2024, clarifying something that caught almost every financial advisor in the country off guard. If the original account owner had already started taking required minimum distributions before they died, meaning they were past their own required beginning date, the beneficiary doesn't just have 10 years to empty the account on their own schedule. They have to take annual distributions during years 1 through 9 and then empty whatever remains in year 10. Skip those annual withdrawals, and you're not just delaying, you're triggering a penalty. This is exactly what happened to Diane Reyes, 61, a retired school administrator from Westerville, Ohio, the woman I described at the start of this video. Her father had been taking his required distributions for almost a decade before he passed, which meant Diane wasn't just under the 10-year rule, she was under the annual distribution version of it. Nobody explained that distinction to her. Her father's financial advisor had retired the year before. The new advisor at the branch gave her the account, told her she had 10 years, and left it at that. Diane, being cautious with money, decided to leave the account untouched, let it keep growing, and take it all out near the end of the 10-year window when she assumed she'd have more clarity on her own retirement income. That $340,000 account grew, which sounds like a good thing, until she found out, through a letter from the IRS too, years later, that she'd missed 2 consecutive years of required annual distributions, and the penalty under Section 4974 of the tax code is 25% of the amount that should have been withdrawn for each year it was missed, on a required distribution of roughly $34,000 a year. Missing 2 years exposed her to a penalty north of $17,000 on top of the ordinary income tax she'd eventually owe on the full $340,000 once it all had to come out. Run that account's growth forward and combine it with the compressed withdrawal window in years 9 and 10, pushing her into a higher tax bracket. And Diane's accountant calculated the total unnecessary cost, penalties, plus avoidable bracket creep at just over $61,000. The fix, and this matters, is that the IRS built in relief for exactly this kind of confusion. Under Notice 2024-35, and the transition relief that followed the 2024 final regulations. Penalties for missed annual distributions in the early years of this rule were waived for many beneficiaries, but that relief was time-limited and required the beneficiary to actually catch up the missed distributions and, in many cases, file Form 5329 with a reasonable cause explanation attached. Diane's accountant filed that form, requested the penalty waiver, and got most, not all, of the $17,000 penalty abated. But the tax bill on the underlying distributions didn't go anywhere. That part was permanent. If you have inherited an IRA in the last 4 years and you are not certain whether you're under the annual distribution version of the 10-year rule, that is the single phone call you need to make this week, because the relief windows on penalty forgiveness are not permanent, and they close. The second trap is the spousal election, and this one is almost the opposite problem. Instead of a rule nobody explains, it's a choice nobody explains you're even making. When a spouse inherits an IRA, not a child, not a sibling, a spouse federal law gives them an option that no other beneficiary gets. Under Treasury Regulation Section 1.4088, a surviving spouse can treat the inherited IRA as their own, roll it directly into their own name. Once that happens, all the required minimum distribution rules reset to the surviving spouse's own age. And if that spouse is younger than 73, they may not have to take any distributions at all for years, letting the entire balance keep compounding tax deferred. The alternative, leaving it as an inherited IRA instead of rolling it over, sounds identical to a lot of people, but it isn't. It comes with earlier mandatory withdrawals in many cases. And if the surviving spouse dies before making the election, the account can default into a status that forces significantly faster distribution to whoever inherits it next. Robert Callahan, 68, a retired machinist from Canton, Ohio, learned this the hard way after his wife of 41 years passed away. Their financial situation was straightforward. Her IRA was worth $410,000, and Robert, still grieving 6 weeks after the funeral, simply signed whatever paperwork the bank handed him, assuming it was routine. What the bank processed was not a spousal rollover. It was a standard inherited IRA registration, because that's the default path if you don't specifically request the spousal treatment in writing. 2 years later, Robert's new financial advisor discovered the account was still titled as an inherited IRA, which meant Robert, who was 66 at the time of his wife's death, was already required to be taking distributions based on a schedule that didn't apply to him if he'd rolled it into his own name instead. He'd been taking out roughly $22,000 more per year than he needed to, pushing himself into a tax bracket nearly 10 points higher than necessary for 2 straight years, an avoidable tax cost of just under $19,000. Here's what makes this trap survivable, though, and it's important. Unlike a lot of tax elections, the spousal rollover doesn't have a hard one-time deadline the way some elections do. A surviving spouse can generally still convert an inherited IRA into their own IRA later using Form 8606 if there's a basis to track, and coordinating directly with the custodian to redesignate the account. Robert did exactly that with his new advisor's help, correcting the titling and stopping the unnecessary distributions going forward. But the 2 years of extra tax he'd already paid were gone. That money doesn't come back. The IRS doesn't retroactively refund tax you paid on withdrawals you didn't have to take. That part is permanent, which is exactly why this election needs to happen in the weeks after the loss, not years later. By accident, on autopilot. The third trap is the disclaimer window, and this is the one that surprises even people who consider themselves financially sophisticated, because it involves something that feels counterintuitive: the right to refuse an inheritance on purpose. For tax reasons, under Section 2518 of the Internal Revenue Code, a beneficiary has the ability to disclaim, meaning legally refuse, some or all of an inherited account and have it pass instead to the next beneficiary in line, as though the disclaiming person had died first. Families use this constantly in estate planning, particularly when an adult child is already in a high tax bracket and would rather have the inherited IRA skip down to a grandchild in a much lower bracket, or when a surviving spouse has enough assets already and wants the account to pass directly to children instead. Done correctly, it can save a family tens of thousands of dollars in aggregate tax exposure. But the window to do it is brutally short. The disclaimer has to be made in writing, delivered to the custodian or executor, within 9 months of the date of death, under Treasury Regulation Section 25.25182. 9 months, not 9 months from when you get around to dealing with it. 9 months from the date the person died, and the disclaiming person cannot have accepted any benefit from the account first, cannot have taken a distribution, cannot have used it as collateral, cannot have exercised any control over it, or the disclaimer becomes invalid entirely. Margaret Alvarez, 59, A retired hospital billing coordinator from Dublin, Ohio, found this out in the worst possible way. Her mother passed away, leaving a $260,000 IRA split between Margaret and Margaret's daughter, who was 24 at the time and just starting her career, sitting in the lowest tax bracket she'd likely ever be in. Margaret's estate attorney recommended she disclaim her portion so it would pass entirely to the granddaughter, dramatically reducing the family's total tax exposure over the 10-year distribution window. It was a sound plan, but between the funeral, the house sale, and a medical issue of her own, Margaret didn't get the disclaimer paperwork filed until month 11, 2 months late. Once that window closed, the option was gone permanently. There is no extension, no reasonable cause exception, no late filing relief for a disclaimer under Section 2518. It is a hard deadline, one of the only truly hard deadlines in this entire body of law. Margaret ended up taking the inheritance herself in her own tax bracket, and her accountant calculated that the family paid approximately $34,000 more in combined tax over the life of the 10-year distribution than they would have if the disclaimer had gone through on time. There is no form that fixes this after the fact. The only fix is knowing about the 9-month window before it closes, which is exactly why, if you've recently inherited any retirement account and there's a chance a disclaimer makes sense for your family, that conversation with an estate attorney needs to happen within weeks of the death, not months. So here's what I want you to do. The exemptions, the breaks, the refunds, most seniors already qualify for but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything's laid out fast and simple, so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now, stay right here because the last trap is the most expensive one in this entire video, and it's the reason I made this video in the first place. The fourth and final trap is what happens when there's no named beneficiary at all. And I want you to really pay attention here because this is the exposure that a huge number of you watching right now already have, sitting in your own accounts without realizing it. Every retirement account, every IRA, every 401k, every 403b has a beneficiary designation form on file with the custodian. That form is a separate legal document from your will. It controls what happens to the account regardless of what your will says. Under long-established federal preemption principles tied to ERISA for employer plans, and under the custodial agreement itself for IRAs, here's the problem. Those forms get lost. They get outdated after a divorce, a remarriage, a death of a named beneficiary who was never replaced on the form. And when a custodian cannot locate a valid current beneficiary designation at the time of the account owner's death, the account does not simply pass through the will like everyone assumes. It defaults to the custodian's own default. Beneficiary hierarchy, typically the estate, under the terms buried in the original account agreement, the person signed 20 or 30 years ago and never looked at again. That default matters enormously because when an IRA pays out to the estate instead of to a named individual, it loses every single stretch and rollover option we just spent the last 20 minutes discussing. There's no 10-year rule with flexibility. There's no spousal rollover. There's no disclaimer planning. Under the regulations governing what's called a non-designated beneficiary treasury regulation, Section 141A94, an estate payable IRA typically has to be fully distributed within 5 years if the original owner died before their required beginning date, or over the deceased owner's remaining life expectancy if they'd already started distributions. Whichever applies. No flexibility, no stretching, and because it flows through the estate, it can also become subject to probate, exposing it to estate creditors and probate costs. It would have avoided entirely with a named living beneficiary. This is what happened to the family of Harold Whitfield, a retired postal worker from Grove City, Ohio, who died at 79 with a $290,000 IRA. Harold had named his wife as primary beneficiary on that account back in 1998. His wife passed away in 2015. Harold never updated the form. When Harold died, the custodian searched for a valid beneficiary designation, found only a deceased primary beneficiary and no contingent beneficiary listed at all, and the account defaulted to Harold's estate. His 3 adult children, who would have split the account and could have stretched distributions over 10 years each in their own names, instead found the entire $290,000 forced through a 5-year distribution window run through probate, with legal and probate administration costs of roughly $11,000 eating into the total before a dollar reached any of them. Compressing $290,000 into 5 years instead of allowing each child their own 10-year window pushed all 3 of them into significantly higher tax brackets simultaneously. Their combined accountant's estimate of the extra tax paid plus the probate costs came to just over $58,000, money that a single, updated form filled out in probably 4 minutes at some point in the 17 years between 1998 and Harold's death would have completely prevented. The fix here is the one piece of this entire video that costs you nothing and takes almost no time. And I want you to actually do it this week, not just nod along. So every custodian, Fidelity, Vanguard, Schwab, your local bank, your former employer's 401k administrator has a beneficiary designation form, sometimes just a section inside their online account portal. Log in or call and confirm exactly who is listed as primary and contingent beneficiary on every single retirement account you own right now, today. If you've had a divorce, a remarriage, a death in the family, or if it's simply been more than 5 years since you looked at that form, there is a real chance it's outdated or missing entirely. And unlike the disclaimer deadline we just discussed, there is no time limit on fixing this one. You can update a beneficiary designation anytime you're alive and competent to do so. The only true deadline is the one you don't control, the day you die with the wrong form on file or no form at all. All right, let's turn this into action because I don't want you leaving this video informed and still doing nothing. Here's your protocol in order. Step 1. Today, this week, contact every custodian holding a retirement account, yours or one you've inherited, and request written confirmation of the current beneficiary designation on file. Don't take a verbal answer over the phone. Ask them to send it in writing or make it visible in your online portal. Only call the number printed on your official statement or the back of your account card. Never a number given to you by someone who calls you first, even if they claim to be from the custodian or the IRS. That's not how legitimate account changes are ever initiated. Step 2. If you've inherited a retirement account within the last 4 years, determine whether the original owner had already begun required minimum distributions before they died. That single fact determines whether you're under the annual distribution version of the 10-year rule, your custodian's cost basis and distribution records, or the deceased's prior tax returns showing Form 199R will tell you. Step 3. If you missed required distributions and believe you may qualify for penalty relief, file Form 5329 with a reasonable cause statement attached, and do this with a CPA or enrolled agent. Not alone the language in that statement matters. Step 4. If you're a surviving spouse and you're not certain your inherited account was properly rolled into your own name, request written confirmation of the account's current registration status. And if it's still titled as an inherited account, ask the custodian directly what's required to convert it, which typically involves Form 8606 if there's basis to track. Step 5. Gather your core documents now before you need them under pressure. Death certificates, certified copies, marriage certificates, prior beneficiary forms, and account statements, going back at least 5 years, and keep them together in one place. Because every one of these fixes moves faster when the paperwork is already assembled. Step 6. If a disclaimer might make sense for your family's tax situation, get in front of an estate attorney within the first 60 days after a death, not the ninth month. That window closes hard, and unlike almost everything else in this video, there is no fixing it late. Diane Reyes eventually got most of her penalty forgiven. Robert Callahan corrected his account and stopped the bleeding, even though he couldn't get back what he'd already paid. Margaret Alvarez's family absorbed a loss that a few weeks of urgency would have prevented entirely. None of these people did anything wrong in the way most of us think about wrongdoing. They didn't lie, they didn't hide anything, they didn't cut corners. They simply didn't know that silence in federal tax law is never neutral. It always defaults to the most expensive outcome available. That's not a flaw in the system. That is the system working exactly as written. The only real protection anyone has against it is knowing the deadline exists before it closes, which is what I hope the next 20 some minutes gave you. If it did, share this with the person in your life who just inherited an account and thinks they've already handled it. There's a good chance they haven't.